Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Leslie Picker, in for Bob Pisani today. The broader markets have been volleying between rallies and sell-offs as many investors hunt for a definitive bottom. But a different set of ETF investors are simply trying to get paid to wait out the volatility. Joining me now is Matt Bartolini, head of Spider America's research at State Street, and Andrew McCormick, Wallach-Beth Capital Managing Director on their ETF trading desk. Thank you both so much for being here. Andrew, I want to start with you. What are you seeing with regard to flows to kind of dividend, quality, value plays? And what does that indicate about an investor skittishness regarding this current bout of volatility?
Well, there's going to be a group of investors that have to have yield, have to have some income coming in. And as we've seen, unfortunately, fixed income hasn't performed like we wanted it to, or like it's expected to in this environment. So you have to get some yield out of it. You got to get some dividends. That's what we've seen. Spider has a great lineup of products to do that. And I think today was really interesting. Just to be timely, I don't really remember, where the market kind of didn't. SDY is a perfect one up on your screen, where the market didn't stay down. So today was really encouraging. Of course, that doesn't mean I think we found a bottom, but that's a positive sign today that the market was able to rally versus just that snapback off of yesterday. And we've seen, people beginning to dip their toes in the water in all kinds of equity products a little bit. Money has to be put to work. So if you're going to do it, value and dividends are a good way.
Matt, what's the overall picture look like for dividends at this stage? There are bank stress tests out this week. Several analyst notes saying, don't expect too much in terms of a raising of dividends and buybacks and so forth. Are you seeing companies really kind of look to preserve their cash and not distribute in dividends? And how is that affecting the overall picture for the ETFs you track?
Well, I think we're not seeing companies cut dividends yet, right? And so there's obviously concerns around growth, and we've seen waning earnings sentiment, but we haven't seen any trepidation with respect to firms' dividends and removing them lower. And I think when we think about, allocating to dividend strategies or recommending them to investors, we always like to ensure that there's a modicum of stability and quality in those. And that's why with something like SDY, it has that rigorous screen of 20 consecutive years. That's just the initial threshold to get into the index. There are some firms that have increased their dividend for over 50 consecutive years, and they have clearly seen some market cycles that are probably even worse off than what we're going through right now, because we are not entering a recession. Economic growth continues to be positive. Earnings growth continues to be positive, albeit it is slowing. So I think what we want to keep an eye on is those firms that have consistently raised dividends. So if there is a concern around dividend growth, that these firms have been able to withstand both economic and fundamental volatility historically.
Andrew, I see in the producer's notes here that you're noticing some selling in commodities funds, and you think they are perhaps going into value funds or value stocks. What do you think is behind that? Do you think that suggests that investors believe that the gains in commodities that we've seen over the last year and a half or so have kind of peaked at this point?
Leslie, that's exactly right. Just a rebalance. There was a good trade. It was an effective trade to kind of weather the storm a little bit. And now, just like Matt said, really you're getting value, you're choosing quality, right? This is not going to be a V-shaped recovery. It's clearly going to be a U, in my opinion. And you just have to start, again, putting money to work. Yes, all these stocks have been beaten down. And if we have a further 10% drawdown or something, along those lines, everything will be dragged down with it. However, again, if you're systematically putting money to work, quality usually is correlated with dividends, or dividends that are done on a regular basis and increasing dividends. So I think that's what that is. That's a trade. Just like I think we'll see some people getting out of the energy trade and just putting money back to work. It's just a little scary to do it in tech, at this point.
And Matt, have you seen that inflection point so far with the dividend trade? You mentioned that many of them have outperformed their respective market exposures by pretty dramatic amounts so far this year. So do you think that they're close to reaching that point where investors say, okay, I've gotten too much exposure, maybe I should look for other opportunities in this current environment?
Not really. I mean, I think when we take a look at some of the underlying exposures, there is that value bias, and we like value as a factor, just given its inexpensive starting point relative to the rest of the marketplace. But also from a value perspective, earnings growth estimates are nearly in line with growth stocks, but you're paying a cheaper multiple for those. There's also some macro underpinnings to it as well. If you look at the sector allocations, they tend to be sectors that are more highly correlated with rising interest rates, rising inflation. You think like energy, materials, bank stocks. There's a positive correlation of value stocks excess return to rising interest rates, while growth stocks have a negative negative correlation. So we like value from that perspective. At the same time, this aspect of quality has been rewarded. If we take a look at it, profitability has been paramount in this type of market cycle. We've seen profitable stocks outperform unprofitable stocks for 12 consecutive months. And as we know, dividend equities, so stocks that pay a consistent amount of dividends, they generally are profitable because they're not going to pay out if they are unprofitable. So we like this overlay of quality and this emphasis alongside value. So even though they've withstood some of the near-term volatility much better than the marketplace, I think there's still more room to run here, given the macro fundamentals, or macro foundations, as well as the fundamental foundations within these type of strategies.
And Andrew, what do you make of kind of the correlation or the interplay right now between dividend stocks and bond ETFs? You mentioned that investors are in a hunt for yield. Are they finding it to be better or more beneficial in these dividend ETFs or in bond ETFs, given kind of adjustments for risk, volatility, as well as potential upside?
It's a great point. I think you get the intelligence that Matt is giving us. And for those of you that don't do it on your own, you can start to think about active management, right? Whether you're choosing a manager or you're just simply doing it yourself, choosing ETFs that are active. So there'll always be money going into both, right? So SRLN is the State Street Senior Bank Loan ETF, which is actively managed, right? So you're getting the benefit of that. Why is that important? Because they are choosing the particular bonds in the portfolio to get away from just being part of this massive index being brought down, and you're depending on Blackstone's ability to pick the right bonds to outperform. This is the time to do it. We're coming through a 10, 12-year cycle where you could just be passive. Even if it was State Street or Blackguard or Vanguard, they all have products that you could set it and forget it, fixed income or equity. And maybe if you're in those products and you have a long-term time horizon, of course, now is not the time to probably sell. But if you have new money to work, either going in an active ETF, if you're in fixed income in this particular case, like the SRLN, which we like, or one of the managers that are on your show all the time, Howard Capital Management or Adaptive or CS McKee, they can kind of make those choices because doing the overall broader market, meaning just the S&P or even the Russell or just doing, the aggregate, the ag ETF, you're really just kind of exposed to all the economic down cycles that we have to work through in the next 6 months to a year. And it might be a good time for active management, again, whether you're choosing the ETF or whether you're choosing the manager yourself. And even if you're choosing the dividend stock ETFs that we just talked about, you're using your head. You're thinking, hey, I need quality, not just the overall market. I think that's going to be the trend in both fixed income and equities going forward.
Matt, what's your take on fixed income versus some of these dividend funds? Do you think that there is an opportunity there as well for investors seeking yield, or is dividend pretty much the place to be?
Well, no, I think there's definitely obviously a role within fixed income. In our view, in our mid-year outlook that we released last week, we talk about limiting duration in the pursuit of real income. In a product and a solution like SRLN, it's one that can do that because of the floating rate nature of the underlying loans, where you basically have a duration of roughly around 0.25 years, and your yield can be upwards of 5% in some cases on some of the underlying loans. But at the same time, you can use something like in the investment grade space, floating rate notes there as well, where you have a duration of essentially 0.07 years. Your yield is going to be roughly around 1.5%, perhaps even more. And that's another way to sort of limit some of the risks in the marketplace, because fixed income investors have basically been even more impaired from a return perspective as equities. When you look at the ag that's down double digits, it's actually going to have unless there's a massive rebound, which is unlikely, it's going to have the ag's going to have 2 consecutive years of of overall declines. That's never happened before. So for fixed income investors, you need to, in our view, limit some of that duration risk as you pursue real income. And that's why we like these ultra short type of strategies. And investors tend to agree. If we look at bond flows in the month of June, overall fixed income ETF flows are in net outflows. And that's been largely dragged down by, high yield, investment grade corporates, some of that, where duration does play a role. What has done well is these ultra short, particularly ultra short government bond ETFs have taken a significant amount of flows. And I think that's where investors are trying to hide out as we navigate through these periods of really episodic and elevated volatility.
Yeah, it's clear that there's some hibernation going on. Investors just looking for any kind of perceived safety. Yeah. Areas to withstand some of the volatility. Gentlemen, thank you so much for being here. Matt, Andrew, really appreciate your commentary. Really interesting conversation. That does it for this week's ETF Edge. I'm Leslie Picker in for Bob Pisani. My thanks to Matt and Andrew for joining us today, and thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.